Welcome to Alan Berry Reports TV. I'm your host, Alan Berry Labucan from alanberryreports.com. Wanted to talk today about some of the reasons that I'm getting bullish for the first time in many, many years. It's only been a couple times. It's kind of a pretty significant departure recently from my long-term sort of situation. I've only been really bullish on the stock market a couple times in well over a decade. Wanted to talk about that because I think that for investors, that's where there's going to be some really good returns going forward, and so I wanted to talk about that today. And as I said, in well over a decade now, since basically the early part of the 2000s, I had been bearish to neutral on the market. And lately, I've been getting a lot more bullish. If you've watched any of the recent shows, you'll, especially during August, you'll be aware of that sort of change in sentiment. And the reason that there's several reasons for that, but I think before I get into some of that, I want to put it into context of what the key reasons of why we're getting more bullish in the Alan Berry reports. Looking back to the late 1990s, there was a raging bull market for right across the board, particularly in commodities or tech stocks. And at that time, what had happened was there was at that time, anything.com, would, if it had a .com in its name, the stocks would immediately start running dramatically. And this was also during this era, there was something that I've long been a believer that where earnings go, so goes the overall stock market. And during this time, so I watch really closely what's happening to companies, and one of the first things I look at is the price-earnings ratio, or PE ratio. Some people call this the multiple of the market. And what that basically means is if you take a look at the price of the stock in relation to the earnings that it has, how many times, say for example, a stock that has $1 of earnings, if it's trading at $20 a share, it would have a PE ratio of 20 or 20 times earnings. And so that's been always a really important key fundamental for me to look at what's happening with earnings. Now, back in the late 1990s, during this anything.com era, this was also a unique situation where the price earnings multiple of the overall stock market, if you either look at the Dow Jones Industrial Average or the S&P 500, the multiple was almost double or at certain times it was twice as much as the average over the long term. So let's say a 50-year period. And so, and often when I would look at some of these technology companies and look at their PE ratio, it had a NA, not applicable. And I made comments to people back then about how I thought that was very applicable. But nonetheless, the market had, especially in the tech scene, had just had these remarkable price earnings ratios. And so at that point in time, I looked at the market and I thought that, there was basically one of two things that could happen. If the price of the stock comes down dramatically, say that example I talked about earlier, the company trading at 20 times its earnings. Say, for example, they keep earning that $1 a share and then the stock drops to $10 a share. Well, now they have a 10 times earnings. So I either was looking for one of two things. Either the stock prices would have to come down dramatically or the earnings would have to go up dramatically. So somewhere over time, if it took a long time for the earnings to catch up to the prices, or you saw a dramatic sell-off, then that would rectify the astronomical price earnings ratios. And so what ended up happening over the last decade plus, we've watched the stock market, for example, today is very close to where it was 10, 12 years ago. And the reason for that is it's taken a long time for the earnings to catch up to the prices. And so going back to since then, I've been bullish in 2008 as well. Talked a lot about reasons why I was bullish back then on my online radio show, and the key reasons that I was so bullish back then had a lot to do with how the price of stocks had come down dramatically. So now the price earnings ratios on average had improved quite dramatically. And at the end of the day, if you want to find bargains, you got to go after those bargains when Mr. Market offers them to you. And I don't think anybody is unaware of what happened in late 2008, early 2009 with the stock market crashing due to the economic collapse in the United States. And so that was why I was bullish then. So now, fast forward to recently, just in August of this year, and we saw another significant pullback in the stock prices. And again, as the earnings have been improving, the prices came down. So now we've got, again, another situation where now we're actually at levels where the price earnings multiple of the market or stocks is very reasonable, even looking back 60 to 70 years. And so, it's basically, I'm 46 years old. I've been following the market for about a quarter of a decade or more, 25 years or more, quarter of a century. And during that time, for most of the time, the price earnings multiple of the market has been significantly higher than the average over the previous 40 or 50 years. And so now we're at that point again where we have the market multiple trading at a very reasonable valuation. Now, since that sort of 2001 period, and prior to that, since then, we've been putting out the Alan Berry Reports email newsletter since we started in mid-2005. And where I saw bargains at that time was in resource stocks and commodities. Now, why I was long-term bullish on commodities had a lot to do with what was going on with long-term long-term supply chain of commodities that everybody was chasing after all these tech stocks in the 1990s. Nobody was putting money into these old economy stocks like mining stocks or railroad stocks or things that were thought to be old school economy type companies. And so during the for much of the 80s and in most of the 1990s as well, there was a severe underinvestment in exploration to find new deposits and also develop new deposits that become producers. And so there was a real weakness in supply, and then you also had this strong demand from China, India, and other emerging economies. And so it was a great way I found bargains in resource stocks, and I also felt that it was a good way to have exposure to the economic growth in rapidly growing emerging economies. Nothing has changed in that regard. When it comes to commodities, I'm still very bullish. I'm still very bullish on resource stocks. In fact, just a few weeks ago, I did a show on reasons why I'm as bullish as ever on commodities. If you look at above me in the shows section of our website, you'll find that show that I'm talking about when I was talking about reasons that I'm still as bullish as ever, in fact, more than ever, on commodities. But what's recently changed is now I'm getting also very bullish on the stock market, and the reasons for that, again, we go back to what's going on with price earnings ratios. Now, as I said earlier, we're down to where even the high growth stocks like Apple are trading at a pretty reasonable price earnings ratio based on forward earnings. And there's plenty of stocks out there right now that are trading at that. I mean, I was just recently looking at all the companies in the Dow Jones Industrial Average, and I think there was only one or two that is trading above a 15 multiple, which is around the historic norm. Prior to the late 1990s, the historic norm had been about 12%, but because of the expansion of the price earnings ratios in the 1990s, late 1990s, it brought the overall average up to, let's say, 15 times. So if you look at the last 30 years or so, the average price earnings ratio is around 15 times earnings, and most of the companies in the Dow Jones Industrial Average are also trading at less than 15 times current, the trailing earnings, and even lower if you look at the estimates for next year's earnings. And so just looking at the biggest companies that are listed on the Dow Jones Industrial Average, and those 30 companies are trading at a discount. Now, I hadn't have a chance to go through all 500 companies in the Standard & Poor's 500, but generally speaking, what happens with the Dow Jones Industrial Average, what's generally happening is also very similar. So I would think that if you went out and did homework on all 500 companies in the S&P 500, those big cap, large cap companies would likely have a very similar scenario. Most of them trading at less than the historical average of around 15. PE of 15, and many of them trading at less than that, significantly less than that, based on next year's earnings. And so, I would consider that stocks in general right now are trading on average at bargain levels. In a nutshell, at the end of the day, I'm a bargain hunter. I think that those that find bargains in the stock market, especially when a company has good fundamentals to go with that bargain price. And that happens often because companies come in and out of vogue, if you will, or style or hype, whatever it is that drives a stock any particular time. But definitely we're now looking at PE ratios that are very, very reasonable. And this is why... And I also believe that this is a trend that's going to continue. Investors are still very fearful. And what causes for example, the growth in the price earnings ratio of stocks in the late 1990s was a widespread enthusiasm for stocks. Everybody thought stocks were going up. Thought that was the only direction that they could go. Plenty of people were becoming day traders. Lots of people talking about it. And then of course the price earnings ratios got to astronomical levels. Now it's kind of much different than that. People are much more fearful now with all that's been going on since 2008 with the economic calamity. There's a lot of fear out there, and when there's lots of fear out there, that's when stocks get to these very attractive valuations. Now, the other thing is it takes a little bit of courage and foresight to be able to be bullish when everybody is very fearful. And especially in August, there was definitely a lot of fear in the markets. And whenever there's this kind of a situation, I'm a bit of a unique character when it comes to analyzing the markets. I basically use two key things to look at a stock. I look at the fundamentals of what's happening with that company, and I also look at the stock's performance. And that combination, I'm finding that right now I'm really liking the fundamentals of plenty of companies, and I'm also looking at the stock price movement and seeing some very attractive opportunities as well. And so those are some of the key reasons. Again, as I said earlier, where earnings go, so goes the market. And right now, investors don't have to pay a high premium for earnings of really high quality companies. And we're going to continue to, as long as these fundamentals continue, we will definitely continue to be bullish on the stock market in general. We maintain our long-term bullish outlook on commodities and resource stocks. I think that in the scenario that I see going forward, I think some of the best performing stocks will be resource stocks, companies that produce and explore for the raw materials that we need to make our world, our economic world run. And so I continue to like commodities. Resource stocks, I think, in a scenario where there's more bullishness or better performance for the stock market in general, I think that's also going to be very favorable to resource stocks. And so we look at resource stocks from small all the way up to the very big ones. And the same thing with stocks in general. And so we're going to be talking about those on future shows. And I wanted to sort of put things into context for the audience that's been following our email newsletter over the years, the online radio show that we used to do. We no longer do those. We've transitioned about a year and a half ago into doing more of our reporting, not in the email newsletter, but in these online shows. And so we really like doing these. We can put them out more often than we did our email newsletter. If we still update people and everybody on our email, so that's no charge to be on there if you're interested. But today I just wanted to talk about some of the key reasons, and the key reasons is why I'm so bullish is right now the bargains that are out there are quite attractive, and again, we'll be talking about those in the future. So on that note, we're going to wrap things up. If you I'd like to stress that the reports and our shows and our website is for information purposes only. We aren't making buying or selling recommendations. It's important for you to do your own homework and speak with your financial advisors before making any investment decisions. We're always trying to grow our audience, and any efforts you make to send along our address, our website, where people can come and find our shows and our reports would be greatly appreciated. Also have to send out some thank you messages. We use youtube.com as our website, our platform to produce and broadcast these shows. They have a great platform for anybody interested in doing online shows, and we highly recommend them. Also, if you look on our if you're watching the show on our website and you look to my left and right, you'll notice that we have banners. Those banner sponsors are really important in us being able to do the work that we do. And if you're interested in learning more about our banner sponsors, you just click on their banner and it'll take you directly to the company's website, where they have plenty of information on those companies. And of course, to you, the viewers, if you didn't show up, we wouldn't have a reason to do this show. So thank you very much for tuning in. And on that note, we hope you can, if you're interested in keeping up with what we're doing, by all means, look above me at the subscribe section. You can subscribe to our emails, and we keep everybody updated, and there's no charge to be on our email list to stay abreast of what we're working on. You can find all of our work on our website at allenberryreports.com. We hope you can join us for our future shows. We'll see you soon, and have a great day.